Hi, I'm Rudi Hoffman, Independent Certified Financial Planner, Cryonics Insurance Funding Specialist. Today we're going to talk about Index Universal Life. It seems that the inflation is kind of built into the fabric of society, the same way that inflation is built into the fabric of the cosmos. And as we're speaking, stars are exploding from us at ridiculous speeds. It's just a pretty amazing thing to think about. Inflation is causing buying power to be decreased. So we got to find some way to beat inflation over time, and there may be better options available to you than older whole life policies. Older whole life policies may not beat inflation, whereas newer programs like Universal Life or Index Universal Life have the opportunity for higher interest rates. And of course, we'd be happy to review any current policies you may have. Universal Life basically allows a growth of whatever the interest rates in the market are. The next iteration is called Index Universal Life. Basically, we put money into a bucket. The bucket of money grows at a certain interest rate. There's an internal cost that comes out of that, basically the cost of insurance, and some administrative costs. So that's the way straight Universal Life works. The distinction between Universal Life and Index Universal Life is pretty straightforward. It may be possible to get a better rate of return with an indexed Universal Life policy. Fixed interest rates right now are ridiculously low, 3, 2, 3, 4%. You get the bank's max. Interest rates, even with insurance companies, are about 3% on fixed products. Index Universal Life, which by the way has been called the Swiss Army knife of financial planning because of its flexibility, and it may be possible to achieve higher rates of growth. You can put more money into it, you can put less money into it, you can basically enable it to use as a savings plan. Basically, I and my family are utilizing this as a tax-free way to accumulate dollars. The dollars are not directly invested in the index. Instead, the index is used as a proxy or determiner of the rate that you get. So obviously, the more money you put into the bucket, the quicker you get that money growing, the better. Right now, the growth is someplace between 0 and 12%. Which basically means if the S&P is up, you can get up to 12% on a good year. If the S&P is down, you can get, the least you get is 0. Basically, the thing stays flat. Pretty simple idea. By the way, if you have an older Universal Life policy, especially if it's old to the 80s, you probably ought to get that looked at because newer programs are simply much better. If you've got a policy more than 10 years old, you need to take a look at it, get it analyzed, see if you can upgrade it. We have a thing called Evolution that improves all sorts of programs, includes refrigerators and cars and computers, and also improves financial programs. Let's take a quick example. Let's say a guy is 32 years old. We'll call him Joe Visioneer. Joe Visioneer is investing $300 a month, for instance, for a $300,000 policy. So if Joe dies, $300,000 is there. But this is like a systematic savings plans as well. It's like a way to pay yourself part of the money you make. And if you're like most people, you find you need some disciplined, consistent investment plan. And this is also not just a life insurance policy. It's a savings plan that becomes self-completing if you happen to die too early. So these illustrations for Joe show that he has a $300,000 death benefit, and also at his age 65, almost $400,000 available in cash value, which in this circumstance actually add together for about a $700,000 death benefit. Now remember, these are just examples. They may not apply to every human being in any given circumstance. What if he couldn't afford the fund right now? Well, he could put less in now and then put more in later. Are there trade-offs? Well, sure, there's got to be. Basically, if the market does nothing but go straight down for the next 30 or 40 years, and everybody starts dying of some pandemic causing all insurance carriers to have to raise their rates, internal rates of insurance, and raise their internal costs, and nobody does anything about that, watching over this for 30 or 40 years, it is possible to shoot yourself in the foot if you're really, really dumb. But we don't think that's going to happen, and we think that's those 4 separate worst-case scenarios are pretty unlikely. So in contrast, think about funding an Index Universal Life. Maybe start with a monthly investment that's comfortable. There's a lot more details. We'll be happy to go over that. And my wife and I have chosen to invest some additional dollars into an Index Universal Life. And if I could reach across the miles that separate us from my heart, tell you this is something you at least take a look at, see if this is a fit for you. And see you in the next video. Have a good day. And we'll talk to you soon. Rudi out.